Ines, also, we keep talking about how we might not be getting government economic data for a little while, and therefore we're paying more attention to some of the private data points. We got one of those this morning from ADP, and it wasn't very encouraging.
No, it wasn't, that data came in lower than expected with jobs shrinking. Look, this has been, the reason why you saw the yields coming down is because of that ADP report. And since that report, you had the FedWatch, now investors expecting 99% probability that the Fed is going to cut in October, because if there was any doubt that, well, the Fed's dual mandate, are they going to cut or not because of the slowdown in the labor market, yet you're still seeing inflation that's higher than what they would like it to be. Well, we're seeing now with this ADP data, which is the one that we have, we'll see if what happens with the jobs data and delays there. But nevertheless, this is indicating that investors now are expecting a cut. Something interesting in the ADP data, too, that came out was that the small and medium-sized businesses are bearing the brunt of this, of the slowdown that you're seeing in this jobs data. So perhaps that K-shaped economy that we talk about when it comes to consumers, we also are seeing this when it comes to companies as well, that the smaller and medium-sized are suffering more than the bigger size. I will note, though, that you still have Wall Street that is bullish on this stock market rally that we've seen. You still have targets that are seeing the S&P 500 going higher. And you just saw commentary recently from Goldman basically saying that the biggest risk to the economy is a slowdown in the labor market. But if the economy can sort of get through this slowdown, then the market can look towards next year for these Fed cuts that are coming, and also as far as the fiscal stimulus, the whole big beautiful bill and all the impacts of that is going to be boosting companies. Again, on the larger side when it comes to that fiscal stimulus, some strategists say, but nevertheless, Wall Street's still bullish despite the slowdown that we're seeing in the labor market.
Yes, for now. Typically, stocks perform relatively well in the months following a shutdown, but this time there are several additional factors at play, including delays of economic data the Fed uses to determine future rate cuts. Joining me now, Ben Emons, FedWatch Advisors founder and chief investment officer. Ben, it's good to see you. Now, maybe Brian is right, who we were just speaking to. Maybe this shutdown won't last very long. But be that as it may, it looks likely, at least possible, that we will not get Friday's jobs report. This morning's ADP report showed a drop of 32,000 jobs. So how are you thinking, what do you do in this situation?
Well, we should definitely trade the ADP number, so to speak, right?
Yeah.
Meaning it's definitely a trend that's now turning negative. And the ADP has become more accurate of what the actual labor situation really is. I mean, it accounts for people on the payroll, private payrolls, so not the government. But nonetheless, it's becoming a more important number. So you see the reaction in the market this morning. Yields declined on it. Mm-hmm. The probability for the rate cut for October went over 100%. So the market knows, these types of numbers are going to drive the Fed towards an outcome of potentially having to cut rates at several meetings to make sure that the unemployment rate doesn't go up that quickly. So I think that's the implication.
I just want to pause for just 1 second, because traditionally you have ADP come out, and then a few days later you have the government data come out on jobs. And I feel like traditionally economists, not that they've discounted ADP, but generally, the government data has been viewed as higher quality and more reliable and giving us a better picture of what's going on. Yeah, has that changed? Why do you think that is? And how should we view, with what degree of certainty do we look at the ADP number? Of course, the government numbers keep getting revised too. So put that in the, as we talk about it, put that in the hat.
Yeah, I think if you think of it statistically, the challenge with the non-farm payroll is that it's 2 surveys. One counts for 2 jobs, the other one 1. So you get that nuance there. Plus this birth-death model that's accounting people for, in the payroll when they open a business, but when they close a business, they don't. And it has over many years caused this fluctuation in the non-farm payroll number that you haven't seen in the ADP number, which, by the way, revises methodology. And I think when that happened, people sort of took 2 and 2 and say, I got a better gauge here where we're heading, in addition to the ISM numbers, which, by the way, always important too, of the employment components there that are kind of forward-looking. how industries think about hiring from here. So I think the payroll number, it's not controversial because when I started in the 90s trading, you also had like a lot of fluctuation in number too. It's no different than it is today. But I do think that the markets have taken this ADP number more seriously. So that's why I felt that probability moving this morning so quickly on this number was telling that the market take this, that the Feds were taking cue from it, saying, yeah, we got to watch the labor market here. Like Collins said yesterday from the Boston Fed, was kind of telling there's significant demand shortfall to supply in labor. That's language to me that's about alarm. It's about we're going to pull the handbrake if we're seeing this labor market deteriorate. So ADP seems to be indicating it.
So all of that said, let's say the government remains shut. We don't get the jobs data on Friday. If it remains shut through CPI, I don't know what we say about that. But do you think that the Fed has enough with what we know right now to cut at the next meeting?
So Waller put in a speech the other day that the Fed's also looking at a weekly payroll number. They sort of use different surveys and construct what actually the non-farm payroll number should be like. I think that probably is for them from a, let's say, staff research point of view.
So they don't rely on government data for that?
Exactly. So they use all private data to get a similar estimate as what non-farm payrolls would be. That's interesting because I think if they have that data, they probably have enough to say we can make our decision well informed. Nonetheless, as Collins yesterday said, if this BLS data becomes more problematic, it becomes indeed problematic for the decision. So that maybe in November or December, more problematic. So we'll have to see. I think at this October meeting, this is probably a pretty set probability that they're going to move because as this data just now indicates today, yeah, we're really sliding down with payrolls.
So what does all of this mean for yields as well going forward?
So it was really notable on Friday that we didn't break above the 50-day moving average. That's maybe a big technical idea, but it's sort of in a downtrend. And it's sort of, I think, saying that we've got a lot of uncertainty. As your guest says, like this tariff uncertainty, for example, is really still overhanging the economy. A lot of companies are reporting on it, like, we just don't really know what we're going to expect here. So I think that puts pressure on yields downward, even though that the GDP data, and the real GDP data, is actually higher and increasing or strengthening. So I think yields are going to go a little lower from here, simply because it has to discount that the Fed has to do several rate cuts to make sure that this payroll data stays in check. I think that's the trend here.